On June 17, 2026, the U.S. and Iran signed a memorandum of understanding, ending their 100-day war and lifting the naval blockade. President Trump immediately authorized the reopening of the Strait of Hormuz to all shipping. Within hours, the resumption of global oil flow caused crude prices to drop below $80 a barrel. Standard economic logic suggests this should have fixed the 4.2% inflation spike. Lower energy costs should lead to interest rate cuts, which in turn typically fuel a massive stock market rally. Instead, markets reacted with a violent sell-off. The Dow dropped 500 points, and tech heavyweights like SpaceX suffered heavy losses. This wasn't a reaction to the peace deal. It was a response to a much deeper domestic threat that the energy breakthrough couldn't touch. To understand why Wall Street would hemorrhage value on a day of historic peace, we have to look at the data that hit the tape just as the oil started flowing. While oil prices were falling globally, the situation on American streets told a different story. A U.S. consumer was spending as if the war and the inflation it caused didn't exist. New Census Bureau data for May 2026 showed that retail and food services sales reached a staggering $763.7 billion. Despite high costs, spending grew nearly 7% over last year. This intense demand creates a rigid economic floor. No matter how low gas prices go, this retail volume makes dropping overall inflation nearly impossible. Wall Street realized the American economy was running far too hot, and that realization quickly turned to fear. The market found itself trapped in a macro tug-of-war. Falling oil prices were pulling toward deflation, but the American consumer was pulling back toward inflation, leaving the Federal Reserve with an impossible choice. This tug-of-war moved the focus to Washington, D.C., where the central bank was meeting to decide the next move for interest rates. New Fed Chair Kevin Warsh was stepping into a political furnace. Lawmakers like Senator Elizabeth Warren were demanding immediate interest rate cuts to lower the cost of living for families squeezed by high prices. Warsh chose to ignore that pressure. Despite the peace deal and the falling oil prices, the Fed announced it would hold interest rates steady in the 3.5 to 3.75% range. The real shock came from the committee's internal projections. 9 of the 18 policymakers forecast a rate hike by year's end, a sharp shift from last month. In his press conference, Warsh stripped out the usual hints about future interest rates, effectively ending forward guidance. He explicitly told investors to stop looking to the Fed for signals and start looking at the raw economic reports. This means the central bank will now react strictly to data like that hot retail report, without offering any safety nets or warnings to the markets. The sell-off was a direct reaction to the removal of Wall Street's safety blanket. Investors were suddenly left to navigate the markets without the central bank's usual maps and hints. The market sell-off functioned as a sudden, sharp adjustment to this change in policy mechanics. We have entered a period where the rules of Wall Street are counterintuitive. In a landscape without Fed guidance, good news for the economy, like those strong retail numbers, is now bad news for your portfolio. Robust data effectively guarantees that the Fed will keep interest rates high to battle the spending floor, which in turn strangles corporate growth and lowers stock valuations. June 17th proved that while a peace deal can solve an energy shock, it cannot cure underlying structural inflation. Wall Street is no longer receiving the guidance it once relied on. Moving forward, the market's movements will be dictated by every new data release, forcing investors to assess the economy entirely on their own.